Good morning, traders and investors. My name is Roger Scott, and I'm Senior Strategist of WealthPress. Today's Tuesday. It's December 27th. The year is almost behind us. I wasn't here on Friday, or actually yesterday. I don't even know what day it was yesterday, but we were in a holiday. The market wasn't open. Today's a Tuesday. It's the first day the market's open post-Christmas. It's about 8:02. It's about 8:03 in the morning now, and the market's going to gear up to open in about, an hour and 27 minutes. Now, as I warned you last week, this is a very, very fragmented market. I mean, look at this. The Dow Jones is up 184 points. It was down 600 points last week. Meanwhile, look at the bond market. The bond market's in the crapper. It's at 101.65, and it was down 1.5 basis points on Friday. If the bond market keeps going lower, that puts more and more pressure onto the stock market. That's really, really important, and especially the technology sector. Now, we've got a lot of data this week. We've got international trades in goods and services. We've got pending home sales. We've got jobless claims, and I'll get into all of that in a minute. But I want you guys to understand, this market cannot be trusted over the next few sessions. It's extremely fragmented. There's not a lot of volume. A lot of institutional traders are out on holidays. So we got to be really, really cautious and very careful. Now, in terms of what news is coming out today, we've got AMC Entertainment. They're down about 8%. They're continuing to fall from last week. They announced they're going to raise $110 million in capital. They're not looking all that great. And I'll talk about more global news as we continue this. So 3 major U.S. benchmark indices closed higher on Friday. As I mentioned correctly, the market was closed. The holidays totally confused my days of week, and I'm already confused to begin with. As market participants digested a deluge of economic data against rate hikes and recession fears, while energy shares climbed, which is a good thing because we're long energies. The 3 major U.S. indices were fueled by utilities, gas, and consumer services. Now, oil and gas and utilities, I totally get. Consumer services, this is what I'm saying. It's a wanky market. Commerce Department revealed U.S. consumer spending barely increased in November, while price pressure eased further, which means that deflationary pressure is working based on what the Fed is doing, or we shall see. The core personal consumption expenditure, the Fed's preferred inflation measures, came in at 0.2% higher for the month and 0.4 and 4.7% year over year in November, in line with expectations. At the same time, University of Michigan consumers showed U.S. consumers expected price pressure to moderate significantly in the next year as one-year inflation expectations dropped to 4.4% in December, the lowest figures in 18 months. I think that number is going to go higher again. I think it's a little unrealistic. And I think consumers got a little happy when the Fed said that CPI is going lower. That's just the start, folks. That's just the beginning. Oil prices rose on Friday, boosting shares of energy companies after Russia hinted at cutting crude output in response to oil price cap imposed by European Union and G7 nations. Folks, till this war is going to continue and till we have inflationary pressure, you're going to see inflated energy prices. I've been saying that since day one. In the coming weeks, market participants will see U.S. pending home sales. That's this week. Richmond Manufacturing Index, initial jobless claims, crude inventories, and Chicago PMI. And when you have all that data, and it's meaningful data with very little volatility or volume because there's lack of liquidity, it can cause a lot of trouble. Investors are going to be focused today on the U.S. goods preliminary balance sheet. It's looking to come in at $98.8 billion in October. They forecast new figure at $96.9 billion. So let's see how off it is. It'll be very interesting. The Europe was up just a little bit before Christmas as positive sentiment continues in the final trading days of 2022, led by gains in industrial, banking, and energy stocks. Folks, those are defensive stocks. China significantly relaxed its travel restrictions, raising hopes of a recovery in the world's second largest economy. That could be a reason why the market's a little extra bullish today. Chinese Shanghai Composite closed higher after the government eased COVID-related restrictions and announced more financial support to COVID-hit sectors, including catering and tourism. Don't hold your breath for that one. China will end quarantine requirements for inbound travelers from January 8th, the National Health Commission announced on Monday. That's great to hear. Let's hope it sticks. How many times have they opened it and closed it in the last 2 years? Don't get me started. The Nikkei stock closed higher after data showed that the country's retail sales rose for the 9th consecutive month in November as cancellations of COVID borders control and government domestic travel subsidiary supported consumer demand. So things are not looking as bad, but I'm telling you folks, we're not done with this. Look at the put to call ratio. It's not oversold anymore. It's now even. It's now at 1. So that means the market could see some volatility. Volatility index via the VIX is right now just slightly above 20, but it looks like it's headed higher again. And matter of fact, if we look at this chart, you will see that we are basing out. See that? Basing out. Excuse me. Right here. And it looks like it's going to go higher. The bond market, now, the bond market's already down at 101.54. And if the bond market continues moving lower, I think we're going to see more downside corrective pressure in technology. Matter of fact, if you look at 20-day breakdowns, you've got 80 stocks breaking down, only 37 breaking higher. Now, this is not a significant number, but it does show that there's a lot more downside potential than upside right now. Now, let's look at each sector so we could see what's going on here. Healthcare leading, industrial leading, consumer staples leading, energy leading. Is this any different that I've been telling you guys for the entire second half of the year? No, it's the same. Now, looking at these, you will see that industrial, healthcare, consumer staples, energy, it looks like it wants to go higher. But if you look at some of the defensive sectors like consumer discretionary, communication services, real estate, it just doesn't look all that great. And either does technology. Look at that. It's almost at their base. So I would be very, very careful, and I wouldn't take this week's trading action too seriously. I really, really would not. Now, today is Tuesday, and Tuesday is a very, very important day because it's the first trading week day of the week. So I want to look at stocks making 90-day breakouts and 90-day breakdowns right now. 90-day breakouts just to see what's going on. Kraft, Merck. Notice the type of stocks that are making 90-day breakouts. Conagra brands, our agricultural stocks. Campbell Soups. You notice you're not seeing Google and Yahoo on this list? Notice that? So I want you guys to see that. Lamb Weston. The same stocks that I've been Quest Diagnostic, medical stock, healthcare stock, Cal-Maine Foods, pet foods, or other foods. The bottom line is Burlington Store, Chubb, defensive stores, not Smuckers. A lot of defensive stocks are up here, and I like that. They're making 90-day highs. 90-day lows, you've got Tesla, Apple, Arc, oy vey. Boyle, that stock that T-Buzz was talking about, Boyle, Pan W, CrowdStrike, Roku. You guys seeing what I'm seeing? Nothing is changing. It's the same. Western Digital, Zoom. Nothing has changed. Nothing. I mean, nothing has changed. The structure of Zscaler, Intellia Therapeutics, nothing has changed. So the bottom line is we're going to stay defensive for a while longer, and I believe this market is going to continue being very, very choppy, and I'm not seeing any Christmas rally. Small caps are in the toilet. ARK Funds is making new lows, and we got nasty news from China on Friday that the number of COVID is actually getting higher, not lower. So this news is a little conflicting. So I think the market is going to be choppy at best. Do not start picking bargains before the end of the year. This is not a time to be a hero. This is time to be very, very skeptical and be very delicate and maybe unload a couple of more positions. We may be unloading our short bond today. We'll see how that goes. Now, before I let you go and run wild, folks, as we wrap up this nasty, volatile 2022 and head into New Year, many traders are overwhelmed with fear. There's an economic uncertainty right now, and it's continuing with interest rate hikes, political instability, extreme market volatility, China, COVID. I mean, I can go on and on and on and on and on, and I really could go on and on and on. But regardless of how you feel today, I want you to head into 2023 confident, prepared with the best tools possible, and a game plan. Oh, yeah, and a game plan. And that's why I'm inviting you to my one-time special year-end event called Turning Point 2023. It's happening at 1 p.m. Eastern time today. I'll reveal my top predictions, top sectors. I'll even give you my top stocks for 2023. Click the link below. Register for this event right now. You'll get all the info and you'll get all the details that you need. You need to get in on this right now. I'll talk to you guys later. Have a great day. And remember, support at marketgeeks.com. Any questions, post in the YouTube Wealth Press channel, and all the links are there as well. I'll see you guys later. Have a great, great day. Bye.